Welcome out to Trading Justice, episode number 200. This is Coach T, one of the co-hosts here at Trading Justice, and, very excited to bring this episode to you. It's going to be a big one, a little bit longer than what we normally do, so if you usually get it done in one workout, you might need 2 days for this one, or 2 commutes back and forth to work. One thing I'd always recommend that you guys do out there is download the podcast. If you have a great app, that's wonderful. If you're on iTunes, that kind of thing, it will automatically come to your phone. I love listening to the podcast when I'm on an airplane or in a car. I think you can turn your travel into a mobile learning center. We learned that from Zig Ziglar, actually. Episode 200 is an exciting one, and we get to interview many of the coaches and mentors that you guys have heard from on our podcast in the past. People like Greg Holmes, who is a wonderful coach, newly named a mentor by Legacy Education, and he conducts our commodities report. Brad May, you're going to like that interview, talking about volatility. Tyler Craig, who's developing a system, Cash Flow Condors. Keith King, where my brother Matt gets to interview him about some of his experience in the market. And Keith is kind of like the godfather of the group. He's been around the longest, and we all look up to him, and he's been a mentor to me. Coach Noah and Coach Gino, and just sit back and enjoy these interviews. And one of my favorite moments in the podcast coming up is with young Jake Larmore, and Jake is a millennial new trader, one person that I'm taking a great interest in. And I know Matt met Jake first and introduced him to me. Just an impressive young man, and really what I think, if you're out there and you're a millennial, or if you are a parent that has a millennial, is an example of what trading and investing and learning, outside of a traditional classroom can do for a young person's confidence, their view on life, and their ability to compound their gains, not just in money, but in life. My brother Matt had a great quote on that as they move themselves forward. Trading Justice is brought to you by TackleTrading.com, and, Tackle Trading is where our community is. The podcast is a labor of love. It's something Matt and I love doing for you. And if you're out there and you've never done this, go on to iTunes and give us a review, a rating, a review. And, over time, we read those reviews back on the air and, give away certain things for that. So we appreciate those people who've done that. Sit back and enjoy Trading Justice, episode number 200.
Tim, listening to your sultry voice on that intro is so soothing.
I think what we should have Cam do is cut all of them over the last 50 episodes together, and then we'll just put it on a loop.
Yeah.
And it will put you to sleep, Matt. Yeah.
Those sleep apps? Yeah, I know. Those sleep apps where you can put a baby to sleep based on sounds of airplanes or water or rain or whatever it is. We'll just put Tim's intros on a loop, and it's just like, ooh, it's got a little Barry White to it.
I'm happy to please. I'm happy to please.
It's really good. Really good.
Giving you the opportunity
I know you are.
to give me a hard time is probably the greatest gift I could give you. So I have no problem.
Yes, it does. It does warm my heart and put a smile on my face. I'm looking forward to this podcast, Tim. It's 200, and I look back over the last few years we've been doing the podcast, and from 1 to 100 and 1 to 200, some of the most amazing conversations with just unreal, awesome traders. From the Pete Thomases of the world to, commodity brokers, to institutional traders, to people who run hedge funds that run billions of dollars in currency daily, to the greats like Keith King and Gino Poor and Micah Brooks, and, to the ones we'll have on kind of the pod here today. It's just been an absolute pleasure to be a part of this. Something we like to do for our students and our listeners is bring them truth on a weekly basis, and sometimes they don't want to hear it, especially like during the election season. I'll say, but we promised that from the first podcast on that we'll bring truth, we'll bring justice. And you can disagree if you want, but this is the one thing you will always get from us is our truth.
And I'm proud of it as well, Matt. And the thing about it is the people who stay with you, those are your community and your team. And if you've been listening throughout the entire of all 200 episodes, send me an email. I'd love to know that. I know for a fact, Matt, We have them.
I know we have
Yes.
them. I know we have them. I know. I've been told. I've been told by people they'll email like, man, Matt, I literally they found us like on episode 150 and they went back and listened to all of them. And my response always is, oh, I'm sorry you had to listen to episode number 2.
The first.
I don't even know who was on 2. I really don't. I don't think we had anybody on first one. I know Michael Kleinhands, an economist out of
It might have been
Indianapolis, was
Jeff
on pretty
Crystal.
early. I know Kurt
Yeah.
Warner, Jeff Crystal. Kurt and Jeff are on one of those early ones as well. Little growing pains there, but it's been a pleasure to be a part of this, and you know, I look forward to another 100 and another 200 and another 500, and you know, it's just a joy on a weekly basis to sit down and talk to an amazing trader like yourself, but also just to get to know so many other great traders. You know, as I travel for Legacy, I always have somebody at my events come up to me and be like, yeah, Matt, I'm here because I heard you on the podcast. I heard Jaime. There's a new student of ours by the name of Jaime, and he came to New York this week. He's like, Matt, I've listened to the last 6 months of the podcast, and that's why I'm here. And I was just like, that
incredible.
Is awesome. You know, to reach people from around the world and people you don't even know exist, but you have somewhat influenced them. I think that's a great honor. And
I firmly believe this, Matt. I think that the podcast has the ability to have the largest reach from an education perspective. I mean, you can have the biggest impact on a one-on-one level. You know, when I sit in a mentorship or something, I'm working with a student, obviously you have the ability to impact their life directly. But when it comes to reaching as many people as we can, you know, we have some potential here to do that. Yeah.
So it's the greatest reach. It's the greatest reach. And as that goes, ladies and gentlemen, if you enjoy the podcast and you like listening to it, and if you have learned from either us or one of our guests, share it with the loved one. Share it on Facebook. Share it on Twitter. Help us get the message out there. And as Tim said in the intro, you know, we love people who go out there and give us a nice little review on iTunes as well. You know, Tim, we got some awesome interviews coming up from the likes of Tyler Craig, Greg Holmes, Brad May, Keith King, Jake Lamore. We have Gino and Noah coming up later on as well. We're just going to have a lot of fun here with the interviews. But, you know, we're cutting this intro after we've already done a lot of the interviews. And, you know, the one thing that stood out to me, Tim, in interviewing all of these awesome traders with years and decades of trading experience is I asked them at the end, I said, what is one thing you will always share with somebody else? And they all said the same thing. None of them knew we were interviewing the rest of them. And they all said the exact same thing. They said, be conservative, treat this long term, get rid of the get rich mindset out there, invest for the long haul. And that's the message that we have put out there at Tackle, at Legacy, you know, with the podcast, this is not about this moment in time. It's not about making $1 million in the next week. It's not about where you're at after a day or a pod or a 3-day seminar. It's not where you're at after you read a book. It's where you're at 5-10 years from now. Every decision we make leads to likely occurrences in the future. And I made a statement. I was giving a presentation in New York this past weekend, and I made a statement to the class. I said, yeah, some individual was concerned about risk, about losing money. And I said, you know what, you're right. You will never, ever lose anything that you don't put into a transaction. You'll have it parked in a savings account, and you have $100 today, you'll have $100 tomorrow, but you will never have a life-changing experience either. And we have to take risk. But we assess risk and reward. We have to take risks to have that quality of life. And I've never met anybody who had the things that everybody dreams about, that they only worked for other people. We got to get our money working in that capacity as well. And so it's been absolute pleasure.
I will say this,
Tim, in terms of these interviews,
you know, I reference Ken Robinson quite often. In fact, one of the interviews I talk about him, and he had a statement in one of his TED Talks, which literally, when I heard this, it made me save it, you know, start using it, replaying it for other classes, things like this. He said, if you're not prepared to be wrong, you'll never do anything original. You know, as an investor, as an entrepreneur, as a creative. I mean, if you're just writing a blog, you want to put out music, name it. You have to be willing to make a mistake. But this is where mentorship comes in, Matt, and all of these answers. Do it conservatively when you're new. Be willing to get out there and take it through the right process. And I do like that message is coming through from every level of our mentorships, and our coaches, and just the whole team kind of understands how we do this.
Well, I love that quote because, we had John Riley on a few podcasts ago, and he's an entrepreneur, motivational type guy, and he was talking about, haters over the internet, and that kind of statement also just made me think of a statement that, well, if you're not hated, you're also not loved. You can do that. You can do that with absolutely anything out there. And that's why these conversations with these awesome traders with vast experience, some more than others, from Keith, who's been in the market for 35 years, to Jake, who's been in the market for a year and a half, is so important for people. Because one thing I wanted to focus on in this episode, in what I find is a very special episode, is learning from the stories of others. We get into trading, we get into the same stuff that we typically do, but we also get into more of the stories of others, learning from the stories of others, be inspired. What I would recommend is you're listening to these interviews, be inspired by their journey. Be motivated by their journey. Utilize that to fuel your own journey in investing. Where you are a year from now is going to be a product of the actions you take within 2017. So what I would recommend is every day of your life in 2017, you do something positive to better your financial situation, to better your credit, to better your investing, to better your knowledge. Do not let one day go by this year that you live in regret in any capacity. And as I say that, guys, sit back, enjoy episode 200. Let us know about it at the Clubhouse, the Tackle. Let us know about it on social media. Share it with others, and we'll keep bringing you the fire and the brimstone on a weekly basis. Enjoy episode 200. We'll be right back.
There's three kinds of people in this world: those that can count and those that cannot. For those that can, we would like for you all to count on us to bring you accurate, up-to-date information about the market once a week, and truly keep you in the loop like a Cheerio. This is episode 200 of the Trading Justice Podcast, brought to you by Tackle Trading. Let's dive back in.
And welcome out to Trading Justice. And we have a very special interview lined up for you guys here today. We have one of the mentors from Legacy Education, one of the coaches from Tackle Trading, a mainstay on the podcast, one of my friends, and just a great, great trader as well. Tyler Craig is here. Matt, you and I, we've known Tyler a long time. As soon as we got into this business, we met Tyler, and I think it was down there in Utah. We were at an office, and we were at a coaching meeting. And since that moment, I've been impressed with Tyler. He's always fun, a professional, and that word fun, I actually do mean that. He knows how to teach and make it fun, and have students, learn as they are enjoying the experience as well. Tyler, how are you today?
Oh, I'm just pleased as punch to be with my two buddies here. Glad you guys invited me on.
Tim, I talk about Tyler at my Legacy events, and I mentioned the first time I met Tyler, I was thinking, what is this 16-year-old doing here? And lo and behold, he probably had more trading experience than anybody else in that meeting. Tyler started trading at such a young age. Tyler,
Matt, at the same time you thought that, I probably thought, what's this old fogey doing here?
That's a good way to put it. That is a good way to put it. Tyler, just as you've been on the podcast before, we talked about your experience and whatnot, but just remind the listeners, what age did you get started trading?
So my father and I originally started in real estate. So he was a real estate student, which one takeaway from that is you can be a jack of all trades, so to speak. You don't have to just be an investor in one field. But so I was in high school, and my dad did real estate, and I hated it because it was all rehabs and hard work, and that wasn't my idea of fun as a high schooler. And so pretty quickly we got exposed to trading, and I said, let's go that route, because real estate sucks as far as I'm concerned, because my only exposure was you work as a freaking construction worker. So I was still a teenager in high school when we started trading.
You
So
know, I was, so
18,
you were
whatever.
like 16, 17 years old, right?
Yeah. Yep.
Yeah. I remember I was at an event one time for Legacy, and I said something about real estate, how, because Tim and I have a similar background, Tyler. We grew up building homes, rehabbing homes, stuff like that as well. And once I got out of that business, it was just like, oh, I'm done. It's way too hard of work,
Yeah.
right? I mean, you got to be a hustler and you got to grind. And I said something about the difference between rentals in real estate and covered calls. And I did a comparison on a covered call versus a rental in real estate about capital that you have to invest into a covered call versus a rental, the liquidity, the speed of use, the ROI, the break-even prices, everything. And everyone in the room was like, "Oh my God, why did we not start doing covered calls years ago?" Right? But there was one person in the room, an old real estate investor, one of those true believers that the only thing you do is real estate. And he raises his hand, he goes, "Matt, why do you hate real estate?" I said, "I never said I hated real estate. I just said I like covered calls better." And he's like, "Well,
Uh-huh.
Robert doesn't like covered calls." And I'm like, wait a second. So you had a conversation with Robert Kiyosaki on covered calls? Oh, you got to tell me about this. Why is it that you feel there are some people that just cannot embrace the liquidity and the opportunity in things like covered calls and the paper assets and digital world, whereas they can do that all the time in a hard asset like real estate?
Probably just ignorance that maybe they just haven't been exposed to it. And well, and the reality is, I guess even if you're exposed to it, if your mindset is one of being closed-minded, which makes you wonder why show up in the first place. I mean, if you're not
It's true.
open-minded to new things, it's like, what do you,
Yeah.
what are you even doing here?
I've asked myself that many times throughout my speaking careers. Why are you here if you're not willing to learn from the teacher?
Right.
It's an amazing thing. In all of my experience, yeah, I feel that people understand real estate inherently better than the financial world because we grow up in it. Even
We
if we've
live in
never
the
done
house.
it's you grow up in a house. Even if you've never owned a home and rented it out, we have rented in our lives. So we inherently understand that. We've probably done a lease option or a rental agreement. We grow up in a house. It's something tangible, physical, we can see. And so we think it's real. But people have to embrace the digital era. Everything is going digital, including currency. And even these
Hmm.
people who struggle with the digital aspect of the financial markets, they still will have 90 to 95% of all financial transactions on a digital credit card, bank transfer, something along those lines. And it's time we embrace that from a digital cover call perspective versus a real estate environment. Now, Tyler, in terms of your experience in the market, when you first started trading, what style of trading did you first embrace?
Well, I think we're all initially exposed to the world of charting and stock picking, and I think that's usually where you get your initial exposure because most people are used to buy and hold, and so by nature, just by default, when they learn about active investing, they think you're just picking stocks, which I think is a bit of a disservice because then they think your success is all about being able to predict the future,
Hmm.
right? Which is kind of where they miss the boat because in the options market you don't have to do that, and so to me sometimes active trading gets a bad rap because people by default think we're just predicting market direction every other day. um,
In
that's where I
essence, you're a
started out.
gambler, right? In essence, you're
Right.
gambling in the market. You're speculating in the market. You have to be right in the market. I think Tim, myself, and you, we all got our start in directional trading, otherwise known as delta trading, where you buy a call, expecting the market to go up, or you buy a put expecting the market to go down, something along those lines. But over the course of your career, which is now what, about 14 years in the market, over
Yeah.
Yeah. So over the course of your entire career, what have you learned about the market though that is different than when you first started, where it was just buying calls and buying puts?
So what? Yeah, one thing would be the um, the I didn't fully appreciate the edge that option selling had, and it was
Hmm.
never explained to me that way. Like if I could go back, and I think that's the perspective we all have in the way we teach and instruct. It's like what you take the good things from those who taught you, and then you improve upon them and say, you know what, I would have done it this way. I would have stressed this, and I would have told people to quickly move away from things like directional betting and buying calls and puts and swinging for the fence, and helping them to develop a more conservative approach that's money over time and not so short sighted, and embracing edges and everything you say, Matt, compounding over time a little bit again and again and again, because your odds are so much better.
Hmm.
And so I love doing exercises where I go back and I say, okay, what if 10 years ago when I was 21, I fully funded an IRA every year and I put the stupid thing in the S&P 500 and I sold a call each month, and every time I could buy another 100 shares, I bought another 100 shares and sold
Yep.
two covered
Yep.
calls and then golfed all year long, right? I mean,
Hmm.
if I compare that to all of the active, aggressive stuff, um, even if I did both, right? Whatever, you implement it however you want, but you look at that over time, and it's like I'm an idiot. I should have just taken that route,
Yeah.
and
Well,
had all this free time.
and that's what Warren Buffett said. Warren Buffett said, "Hey guys, listen. From a long-term perspective, it doesn't have to be difficult. Pick a broad market index like the S&P 500, and simply buy that." And about a month ago, Tyler, I put up a blog in our clubhouse, our new clubhouse over there at Tackle Trading, and it was my research on 2013, 14, 15, and the first half of 16 versus an average mutual fund and the market index. The average mutual fund over that time period went up and I compared it against a $100,000 portfolio. So over the course of that 3.5 years, the average mutual fund went up about 38%, which is about $38,000, and that's before many of the fees are deducted out of the performance. Okay, so most of the fees are deducted out of the performance, and then so it's actually less than that. And if all you would have done was just buy the spiders, you would have went up 58% over that 2013, 14, 15, and early 2016 route. So the difference was about 20% in just that short time period in just picking a mutual fund versus just picking the broad index. But you said something, if you just learned how to write a covered call against it on a monthly basis. I did that as well, Tyler. And in just writing a covered call in the S&P 500, and all I did is take 1.5% on average monthly return on that, which typically it's a little bit more than that. So I went very conservative with that. And with the cover call, it was about $215,000, which was about a $75,000 difference just in that 3.5 year time period. That's how important financial education is in terms of that. Speak to the power of the cover call.
Well, so I think one thing that the cover call shares as a characteristic with many other successful approaches is just the consistency, right? Doing the same thing again and again and again and again. Because some people, you learn the advantages of a particular strategy and then you try it once or twice, and it's kind of completely random in the short run as to whether it works or it doesn't. And the reality is, if you want the benefits the strategy is willing to give, you have to keep doing it. You need a large
Yeah.
sample size, and it works over time. And so with the covered call, we talk about cash flow, we talk about less volatility in your returns. In the short run, you don't get that. It's in the long run. So you do one cover call, it works or it doesn't. And then people often pass judgment because they're short sighted. And it's like, no, dude, you got to do it over months and months and years. And then you really start to see the benefit. You don't need to wait 3 years, just take my word for it. But you got to be consistent with whatever approach you select.
Yeah. And it's to really embrace that, what people have to do is they have to shed the get rich quick mindset. And that's where a lot of the risk factor comes in terms of trading. And that's where a lot of the horror stories that people have heard in trading about people who have went out there and taken $10,000 and they lost it all because they did not embrace long-term investing. They did not embrace conservative cash flow. covered college your first month isn't going to make you rich. It's just not. Your first year, it's not going to make you rich, but it will make you rich over time. And that's the power of long-term investing, taking a very conservative approach to the markets. It absolutely amazes me when people see the numbers of the average movement in the market on a monthly and a yearly basis, how they could think that this market is anything but conservative. And that those numbers, and I want to talk about those numbers because that led us to create a new system of investing called cash flow condors that, Tyler, you put the finishing touches on just last year, and we're getting ready to release to the tackle trading community. Tyler, let's talk about why we created cash flow condors. First of all, what is that system?
So it focuses on a particular option strategy that sounds fancy, but it's pretty simple, known as the Iron Condor. And we structured it so it was quite conservative. It has a very high probability of success. And we use the analogy that it's kind of like an insurance company, where people know that insurance companies have great business models where the numbers are in their favor. They price policies such that over time they make money, and they're betting against rare events happening, right? They're selling flood insurance, or they're selling cancer insurance, and the majority of the time these insurance companies just rake in the premiums, and occasionally they have to pay out, occasionally they're wrong, but they structure it so they make money over time. And there is a way of doing that in the options market. The options market's like an insurance market. And so in the cash flow condors system, we teach you how to be an insurance company and how that translates into the options market, where you're not betting on direction. You're not guessing what the market's going to do every other month. You're just consistently selling options, selling insurance as a means of betting that the uncertain thing, the rare event, won't happen. And that's the short answer. I can go on, Matt, but maybe that's a good intro.
You say something in the intro to cash flow condors. You say we are short perception and we are long reality. And the perception out there in the market, not everywhere, but in certain segments of the investing trading community, is that the market is fast, it's volatile, it's crazy. There's a perception out there that when we look back to 2008 and 2000, 2001, that the market just literally just took a dump, right? Just in 2 days, it was just everything was dead to the world. But these individuals, they don't understand the reality of the situation, that if you track the market all the way back to, we'll say 20 years, right? So let's go back to 1997. If you track the market on a monthly basis over the last 100 years, the average price movement in the market on a yearly basis is right around 8%. If you track that from a monthly perspective, it's right around 0.007% average movement. Now, that's obviously an average. So if you take into account even bear markets in 2001, 2002, and in 07, 08, 09, if you track that, the average drop in price is about 50% over a 2-year time frame, which means the average drop in price during even bear markets is right around 2%, right around 2.1% on average on a bear market. And if you track based on just how many months that the market has moved either up or down and finished a 10% movement up or a 10% movement down in the market, you're really talking just a handful of times. We're talking 5, 6, 7 times in the marketplace. So outside of that, those moments in time where the market just does not move that much, you're talking high probability, 96, 97% of the time, the market doesn't move that much. And so what our philosophy is in cash flow condors is we're just going to act as the insurance company. We're just going to say that, on average, based on market probabilities, that the market simply does not move that much. And if it does not move that much, we're going to cash flow on a monthly basis with cash flow condors. We're gonna bracket a major market move, 10% up, 10% down, and if it doesn't get that, you're going to cash flow 8, 9, 10% on a monthly basis. And I think if you understand those probabilities, we are long the reality that this just does not happen. We're short the perception out there that it does. But even if you know those numbers, Tim, Tyler, myself, we all know people that believe the market's just going to die, right? That it's just gonna tank. We call them doomsdayers, right? In terms of this mentality, I want to talk to Tim real quick. Tim, in
Yep.
terms of the mentality of the doomsdayer, how many people have you met that just do not understand those probabilities I just laid out?
Well, a lot, and this is why what I loved about the cash flow condor stuff, and I love the way Tyler approaches this whole thing is you do it through back testing to prove it to people. One thing that you guys said a few minutes ago that I thought was really important to understand is that if you're new, we don't just go out and try something and see if it works, because then you can miss out on the boat. Matt, I remember when I was a new trader, I tried iron condors, and I think I lost on one of my first trades because I used too high of a delta, and so I didn't really
Probably
use
a
it
20
for.
delta.
Yeah, I didn't use them very much for the first few years because of that. And I think that when you have a mentor like Tyler who approaches it from a backtesting perspective to show you where the money is out of the money, because all those doomsdayers do exist, and they, quite frankly, they always think the markets are going to crash, and that's why there's money so deep out of the market in the put side.
Yeah.
I mean, there's some complicated stuff in there like volatility that we measure. But what I love about systems that are designed like this is that we show people through back testing and through data where that risk is, so people don't have to wonder about it, right? And how the actual thing plays itself out over time. And I think that's an important part of any good system.
Well, and when we all started doing iron condors, I'm willing to bet that your first iron condor was too high of a delta. So was mine. And I'm willing to bet that that was on a stock and not an index. A stock
Mm-hmm.
like Amazon, a stock like Priceline, Google, doesn't matter. You can do iron condors on those stocks, but those stocks have a tendency to move fairly quickly. Those stocks have a tendency to move 2% every single day, versus what the market does. Those stocks have a tendency to be very prone to news and very prone to volatility shifts. Anything can move Amazon 10% in a month, and anything can move Google 10%, either up or down in a month. You're also dealing with individual earnings announcements that can throw off probabilities as well. But it is very, very difficult to move 2,000 stocks that far. The index is just too big for that. Whether you're talking the S&P 500 with 500 stocks, or whether you're talking the Russell 2000 with 2,000 stocks, when you do this system, and this system is predicated on the Russell 2000, when you do this system on the Iron Condor cash flow system on the Russell 2000, it's very, very difficult to move that many stocks. There's too much money there. But it does happen. It does happen. Tyler, we also give the analogy that it's like an earthquake. An earthquake happens. Everybody's willing to buy earthquake insurance. But earthquake insurance companies are very willing to sell people earthquake insurance. We had an earthquake here in Utah in 1988. And after 1998, everybody started buying earthquake insurance, and yet we have not had one earthquake since. That's the same type of that's what we're simply saying with cash flow condors. And I think it's vitally important that every one of our listeners embrace the concept of cash flow. Tyler, from a delta to a theta perspective, delta is what we started in, theta is what we evolve into. If we could get people to embrace theta, right? If we could get people to embrace theta initially, will their success go up? Will their long-term cash flow go up in every capacity?
I would say undoubtedly. I mean, the way that people screw it up is with their sizing. They just want to make too much money too fast, and so they go too big. As long as you don't go too big, you're fine. And so the thing with theta is if you can just have a mentor or a coach help you understand the proper sizing. I mean, the objective with this cash flow for condors is you could sell these every month for the rest of your entire life. The key is you just don't do so many so that in one earthquake you blow up. And so the beautiful thing about the trading system and the video series is, look, anybody can teach you what an iron condor is, but to be able to walk you step by step through the theory behind it, really understanding why it works, is what helps you stay committed, and understanding that you need to stick with it over time. We've got an entire module on risk management that talks exactly about expectancy. We have one on back testing. And so the beautiful thing with this is it's a self-contained, fully implementable. That's even a word.
I liked it. If it's not, I liked it.
Sounds good. Implementable trading system. So we build this puppy from the ground up to really give you all the tools you need to have the confidence that, look, we want you to do this for decades and decades.
Yeah, and I think that one thing is so vitally important: position sizing. If you put 50% of your money in any one system and something bad goes wrong, it takes you way too much time to make that back up. But if you have proper portfolio design, and if you have proper position sizing, and you put 10% of your portfolio in a system with 90% probability of cash flowing 10%, then you're going to make money over time. Even if that one scenario happens, and a lot of these scenarios we call black swan. Even in that one scenario where something unexpected happens, like a Lehman Brothers event or a 9/11 event or a Swiss SMB Swiss franc event or a Chinese slowing growth event that we've had in recent history, then even in those moments in time where the insurance does not work, it's still going to work out over time. And it goes back to insurance as a whole. You can guarantee insurance companies are going to make money long term, not in every time frame, but long term. And you can guarantee a casino who understands probability will make money as well, but casinos only fail with mismanagement, and that comes into position sizing. You've been listening to the Trading Justice Podcast, episode 200. Tyler, we are on our 200th episode. And we just felt like bringing you back on for the 200th was so vitally important to us. You do such a great job as a mentor and as a lead trainer with Legacy, and as a coach over here at Tackle. Working in that community, it's just a pleasure to have you be a part of our team. So Tyler, thank you so much for coming on the TJ Podcast. We'll be right back after these words from Cam.
At Tackle Trading, our coaches put together an awesome market scoreboard and 4 reports: the options, the stocks, the commodities, and the Forex report. And we're sure you're going to love it, just like a person in Wisconsin loves cheese. Don't you know? Yeah, we know. Go Packers. Before you invest your money, invest your time with Tackle Trading.
Welcome back. Trading Justice episode number 200, where we have a lot of fun putting these together, and very excited to bring another one of our guests on. He's a coach at Tackle Trading, does our commodity report every weekend. He is a fantastic man, very interesting guy. I met Greg a little over a year ago, I'd say, and it's been quite a journey getting to know Greg and watching him develop. He was named a mentor by Legacy Education, which is an important part of his journey. Greg, how are you doing today?
I'm awesome, Tim. Thanks for having me on the
Greg,
podcast.
Talk a little bit about your journey in the last few years, because you went from being a trader to where now you're a coach and a mentor, and now you're giving back. What does that mean to you? How did that develop? Give us a little bit of the backstory on that.
Okay. Well, myself, I started out as a financial advisor a number of years ago, and I realized that wasn't the best way for me to help people. So I got into the world of trading, started trading on my own, had some successes, some not successes. And I realized that I needed some education. So I went out, got some education, took the legacy courses, got a few mentors, learned a bunch, practiced a bunch, took a few beat downs, had some successes. And I felt that once I got to the point where I was trading well and having some success, some more consistent success, that I wanted to get more involved. I found that I have a real love for trading and markets in general, and I really like helping people. The reason I became a financial advisor back, a number of years ago is because I wanted to help people. I saw some problems in the system, and I thought I could help. And so once I got to be a trader, a more consistent trader, I felt that I was better off to teach people what I'd learned, because I knew that it helped me in ways that I could never help in another forum. So I got involved with a few folks at Legacy, and then a few of you guys there at Tackle Trading, and just kind of blossomed from there. I learned a great deal more. I mentored my first student a number of months ago. She's doing quite well. She took to it very well. It's one of the most rewarding experiences I've had in my life, to be able to share my knowledge with somebody else, and I'm the type of guy that I'll talk trading with anybody. And so if I can impart some knowledge to somebody, whether it be through the commodity report or through a conversation or through a full mentorship, you really get to know each other when you're working one-on-one. And I'll tell you that experience that I've had in my life, I've had half a dozen mentors. I still have a couple ongoing now. And I think that's one of the best things that I've ever done, was to put myself in the company of others who've been down the path that I wanted to go. And I'll tell you, it took my trading from being, basic to really, really rewarding and successful. And I can't thank my mentors enough for that. So I'm glad to be
that kind
in
of
that
conclusion
space.
to the educational process is a big part of most people's dream when they get involved with this stuff. Matt, you and I, we're out there, we meet new traders all the time, and one of the big visions I see from people is that they want to develop a legacy. Part of that legacy might be teaching their family, giving that education to their kids, or just giving back in general. I think that the mindset Greg just described here of being a mentor and wanting to help people is a big part of, being a good coach to begin with, right? You have to have those instincts. And I know that you and I, we were raised that way to be involved in coaching. It might have been something to do with team sports. I don't know. Matt, what do you think about this?
Well, I'm listening to Greg and his process, how he's went about things and whatnot, starting out as an advisor, moving on to an individual trader, eventually realizes that it's not as simple as going from advising people on traditional retirement models versus active trading. It's a different beast. It's a different world. It's a different industry from passive to active investing. Recognizes he needs some help a few years back, in 6-7 years ago. Gets the help through Legacy, gets a mentor, learns how to do it the appropriate way, and then gets into and then finally becomes a mentor himself. And the student now becomes a teacher, and this is a process that has been going on since the dawn of time.
Mm-hmm.
And I just think it's a beautiful process that somebody who recognizes the right way to do things, learns how to do it the right way, and now is teaching other people how to do it the same way. It's a beautiful, beautiful thing. And I do believe that, there's a reason we named tackle trading. We grew up in a sports environment, playing sports our whole lives. Any successful team in any capacity has, they work together, they help each other, they have coaches, they have assistants, but at the end of the day, they work together, and the success of a team is predicated on, teamwork to make the dream work. And it's not about us as the individual, it's about us as a collective community. And I think having Greg part of that collective community has not only helped you and I and the rest of Tackle, but the students at Legacy and in our clubhouse and through his scouting report. And I just think it's a beautiful message.
Yeah, absolutely. And I'm with you on the sports theme. One thing, Matt, that I don't know if you know until we were talking a little bit before the podcast, but Greg actually used to play rugby. And Greg, correct me if I'm wrong, I believe that was for a professional team. Is that right?
No, it wasn't. It wasn't professional. It was a club team, but I have played internationally. I appreciate the pump up, but no, I played rugby for over 20 years, and I was fortunate enough to be able to play some games overseas. I played in Germany, played in Amsterdam and Belgium as well. I got to go on a lot of tours and played some folks in other countries, and got to really got to see what life is like in other places. And as you guys were talking about the team mentality, it doesn't matter where you are in the world, when you're in an environment like trading or sports of any kind, or even business in general, the people who excel are the people that work as a team. And I'll tell you, without rugby, the major part of rugby, the only thing you need to know to play rugby is go forward and support. Meaning, if you're not the guy going forward, you're supporting the guy that is. Well, you know what? We do that in tackle trading every week. So that's what I took away from 20 years of rugby. A lot of good memories and that team building attitude.
Tim, I went down to Australia on a football team to play down in Australia when I was younger, and we went to a rugby game down in Australia. And growing up in the States here, Greg, football is the toughest, meanest sport. Nothing ever competes with it. You lace those shoelaces up, you put that helmet on, you pad yourself up thick and thin, and you go out there and do some damage. And so all of us badass little football players from Utah, we're on this little all-star team down in Australia right after high school. And we go to this rugby game, and I remember watching these guys without pads hitting as hard as we were hitting with pads. And this Australian guy, he takes a hit to the head, and he has this gash, just this huge gash right down the middle of his forehead, and he is just spewing blood, right? And I'm like, oh my God, this is ridiculous. And he literally just comes and wipes off the blood and runs right back out there, just right back out there. And I was like, oh wow, he is so much tougher than me. It's just rugby is even more of a team game, and that was my one and only exposure to a live rugby game. But it was really fun to watch, and to hear you played, 20 years playing rugby. Man, I just got mad respect for your toughness there, Greg. But a club, you were on a club team. I think, Tim, that's the equivalent of like AAA baseball. So it's pretty up there.
Yeah. Well, I mean, you traveled to Germany and internationally. I remember you told me, Greg, you played in the UK as well. I always kind of wondered this, and it was a question I wanted to ask you here today. Traveling, did that teach you a lot about currency exchange and then kind of get you interested in some of the money aspects behind the financial markets? I mean, just moving around the globe, I can't imagine you would be able to avoid that a little bit.
Yeah, it's an interesting perspective, because when I was doing that traveling, I wasn't in the trading mind frame, if you will. But once I got further into the trading, I realized that, when I was doing all those currency exchanges, when I was, exchanging for pounds or, Canadian dollars for pounds or, whatever, it happened to be, I always felt like, man, I'm taking a bit of a beat down here on the currency exchange, because, of course, the Canadian dollar is always, weaker than most for the most part. So, after I got into the trading mode, starting to look at the currencies and being able to trade those, and effectively, I don't want to negate the conversion or anything, but at least being able to control it to a certain degree was very interesting to me. And I wouldn't say that's my number one expertise, but it's something that's very important with whatever you're doing, especially me being from Canada. I'm always trading in U.S. equities. And so there's always that conversion, that currency conversion. So it's a big deal. It's something you got to take into consideration when you do your trades. Right?
Tim. I haven't traveled extensively throughout the world, but I have traveled extensively throughout the United States and met a tremendous amount of people that are from international. And I will tell you, because they have so much more exposure to the international conversion, right? The international conversion of currency. they are so much more financially intelligent when it comes to currency and what currency truly is. They've had to deal with the exchanges. They've had to deal with the devaluation. Like Greg just said, he goes, I've had to deal with because the Canadian dollar is typically cheaper than other places. I've had to deal with, exchanging mine for a more expensive currency, right? In the U.S., we don't do that. Like, for example, I traveled to New York City this past week. Went to New York City. I took my American dollars and I spent American dollars there. I flew back to Salt Lake City and I have my American dollars. I use American dollars there. I don't notice the devaluation on a daily basis. I don't notice the currency trade on a daily basis. But in international communities, they are much more fully aware of currency and currency transactions and commodities as well. Greg, you primarily focus not on the currency market. You primarily focus on the commodity market. Why is it? What made you want to learn commodities? Number one, what was the draw the commodity market had to you?
Well, for me, commodities are, okay, so when you first start trading, most people start trading stocks, companies, those kind of things, or maybe indexes and those kind of things. And those are, even though I own shares of companies, it wasn't kind of, real hold in the hand kind of stuff. But once I started to get into the commodities, you're talking your oil, your gold, your silver, those are real, tangible items. You know what I mean? It's not just like if I own a share of Microsoft, it's a piece of paper, mm-hmm. right? But if I own an ounce of gold, or if I'm trading an ounce of gold, it's kind of I just want to say more real, yeah. I guess. And so, I took an interest in getting more educated about the commodities, and I find there's that boom and bust kind of feel to commodities. And so I always, it affects Canada a lot because we are primarily a resource-based country, right? So that also kind of pushed me towards the gold and the oil, those kind of things. And I just instantly took an interest to it and wanted to learn more about it. And I really enjoyed doing the commodity report because it is interesting to me.
We do consider the Canadian dollar a commodity-backed currency because of your national economy is largely predicated on mining of precious metals, oil, and so on and so forth. And those two markets certainly do go hand in hand. Greg, if you could give one piece of advice from all of your experience, you were an advisor, you were a student, you are now a mentor, you've traded stocks, currencies, commodities, options, you name it. What would that one piece of advice to somebody who is very new to the market be?
I think the best advice I could give is start small. You're going to learn a lot, and a lot of people who get in trouble in this business, they get too active too fast, or they get a little bit of success right up front, and then they don't realize that they don't know enough, and that comes back to bite them. But if you start small, get educated, and kind of progress slowly, you're going to be a much happier trader. And I'll tell you, as a beginner, I wish somebody would have come along and told me that first. It would have been much more beneficial to me.
Tim, I think what Greg just said is wise words, and it's something that you have heard repeatedly from our podcast in that tackle and at Legacy is that, what, guys, from our experience, we started out aggressive. Don't do it. Start out conservative. We were the lucky ones to a certain extent. You've been listening to the Trading Justice podcast presented by Tackle Trading. After these messages from producer Kim, we'll be right back with yet another interview in TJ 200.
You've been listening to the Trading Justice podcast, proudly sponsored by TackleTrading.com. Get off the sidelines and get in the game.
And welcome back to episode number 200 of the Trading Justice podcast. And, the thing about it is we have an amazing community, mentors, coaches, teachers, other traders and students, and everybody at all different levels of their journey. Our next guest has been a frequent member of our podcast. I think Brad has been on 2 or 3 times. I'd have to go back and keep track of it exactly. Brad is also a contributor through the coaches over at Tackle Trading. He does some of the market scoreboards and some of the scouting reports like the stock report and the options report. If you've not listened to Brad's interview, I'd like you to go back and find those episodes. There were some really tremendous ones. I love Brad's story. Without further ado, Brad, how are you doing today?
I'm doing awesome. Thanks for having me, Tim. I appreciate it.
Yeah, no problem, man. I love your participation with our team. I got to tell you that right out front. I see what you're doing. I love the activity. You engage on the clubhouse. You're out there helping. What has driven you to want to become a coach, Brad, and start helping and giving back? I mean, you're a fairly young guy. I think, just had your second child. Is that right?
So I've got two. I've got a 3-year-old, 18-month-old, and we got one on the way in May. Having another girl, our second girl. So
congratulations, my friend.
And I'm 27, so you're right. I am young still.
Very blessed. And you've been trading now for how long?
About 4.5 years, since 2012.
Yeah, and so you started with the education, and you started with going to classes, and you took mentorships, and you've got a very specific trading style that includes options and stocks, and that's where your specialties lie. I would also say in the volatility markets. So, being in the market for 4.5 years, you obviously have a lot to give back. I was named a mentor myself, Brad, when I was 27. So it kind of it resonates with me, your specific nature of your journey. I've been doing it 12 years now. But after I've been trading for a couple of years, I was named mentor, and I started helping people one-on-one. And that whole process of coaching and mentoring and working with classes and other students, it's very rewarding. What can you say about your experience, through that process? Are you enjoying it? Are you finding it challenging, rewarding? What are your thoughts?
I love the fact that I get to give back now, because there were so many people who helped me along my way. There's no way I could have, learned trading and all of this stuff for the past 4 years on my own. I've had mentors, like you said, and even you guys, not that I haven't been like personally mentored by you, but being a part of tackle trading this whole time, I feel like I have been almost, through everything that we've done and through the site and everything. And I'm just excited to give back. I love doing the reports because I get to give a little bit of my knowledge to you guys, and then I love reading if you leave comments on there. Like, that just makes my day when somebody's like, oh yeah, you taught me something new. I never thought about that before. And I'm like, okay, cool. I'm actually making a difference, giving back. I've went through all this training, everything, and now I can train other people. It just feels good. Yeah,
it does. Well, first of all, it's pretty awesome when you see other people using the information, the knowledge you have, and it's helping them. It's not always victories at every moment. And one of the things that you'll learn as a coach and, developing into this role as well, is that there are times where you got to be, very direct and kind of help them by giving them some feedback they may not want to hear. It's a different kind of exposure when you're doing it from like the market scoreboard standpoint, because you know that your video is being watched and listened to, and people are using it all over the world, and there are literally hundreds, if not thousands, of traders that go through that every week. Once you get to the point, and you will at some point in your future, Brad, that where you work with somebody one-on-one, like in a mentorship role or a coaching role, it's even more rewarding, in my opinion, because you have that direct kind of impact on that person's life. So I'm excited to see you develop into that. In your life, is that something you'd be interested in? Is that kind of where you want to see your future? Would you like to be a one-on-one coach and mentor? Or?
Yeah, definitely. I've thought about that a lot, and it's kind of one of those things where you just keep progressing, and I'm just trying to move forward a little bit at a time, and I feel like I am getting to that point, especially with all the training that I've just done with you guys through all the reports and whatnot. I feel like I'm getting to that point, so it's pretty exciting, actually. So
all in due time, and the thing about it is the way that mentorships work is usually other mentors take note of the people like yourself, Brad, that are doing that kind of thing. And so I'd be excited to see you develop into that role. It's all a big journey in life, and trading is a big part of that. You've developed a niche here where you can trade the markets. You still do work full time as well, raising your family. Do you see yourself trading forever? I mean, how does this fit into your life plan?
Oh, yeah. Yeah, I can't picture not trading anymore. But definitely one of these days I won't have the day job, and I like the advice that you've been given, I guess, you and Matt, by somebody else, is try to have at least 7 types of income. And I'm trying to work on that, building businesses and just with different ideas that I've had through programming and stuff. So I'm trying to get to that point eventually. And working on a lot of different stuff, but trying to focus on one thing at a time. Well,
7 sources of income, but they all can't be 70 hours a week of a commitment, right? You have to do what, like Robert Kiyosaki talks about, learn to make money while you're sleeping. Warren Buffett has great quotes on that regard as well. And I'm with you. 7 streams of income, 7 different ways of making money. I think it's an important mindset. I was just talking to Matt about a week ago or so, and one of our personal goals is to do some kind of new business every single year, whether it's a startup or a new income stream or back into property, who knows. But I'm with you as well. I'm not to 7 myself, Brad. Excuse me. I'm not to 7 myself. I'm building that out, and I'm trying to get that up and running and up to speed. And I think it's an ever ongoing process of being an entrepreneur that you have to keep pushing. I think one of the best things that we can ever do in the trading world is have systems that have a low degree of difficulty to execute, right? Which is why I like spreads and I like volatility trades and high probability trades. This is a lot of what you trade, correct, Brad?
Yeah, I focus a lot on Vega trades, which is not what everybody does, obviously. You don't hear about them as much. You'll hear about the theta, delta, whatnot. But Vega is one of my babies, yeah.
Yeah, so walk us through a process in Brad's world. How do you find a candidate? And you don't have to go too deep, high level here. Remember, we have beginners out there as well, but let's show these guys a little bit what a trader will do. How do you find a candidate? How do you evaluate it? How do you make a decision to pull the trigger? How much of a time commitment is it to manage it? All that kind of stuff. Walk us through a trade.
All right. So my biggest thing is Vega is most predictable around earnings, obviously. So that's my go-to. I usually don't play Vega strategies unless there's an earnings announcement or something coming up like that. So typically I have, custom scanners on Thinkorswim that I'll say, okay, these companies that are liquid and have weekly options, usually is what I look for, are reporting within the next week. So I'll be forewarned of those, and then can look at the options on those, go through and see if I'm trying to do something before earnings. I'm going to look for if implied volatility should be going up. So I actually have my own custom indicator that I built that basically tells me on average how much does volatility go up, how much does the stock move from prior earnings announcements, and I can apply that to the future. And usually I'll go back to think back or something and back test for at least the last year or two on individual stocks to see if that strategy, like a straddle or strangle or something, actually works on that specific stock. And then so once I've found my candidates, I'll go in and a lot of times I actually use our own tackle trading spreadsheets and stuff, and go through there and try to see which one actually is the best ROI and all that good stuff, and then narrow them down and just pick a few to play, and do it that way. So
I love it. And so from start to finish, do you think maybe to research and find your trade, does it take half an hour?
Yeah, it's not much longer than that, honestly, and I would say not each trade even takes that long. A few trades could take that long. It doesn't have to take all day, and once you get used to it and know the strategy and you have all of your rules written out, it's second nature, and it comes pretty quickly. It's just getting to that point that takes longer, obviously.
If you're out there and you're listening, the big takeaway I want you to pull from this discussion here is that trading is dynamic. It can happen in a lot of different ways. You're going to use a strategy. You're going to learn that strategy. Obviously, there's some terminology. I'm sure that if you're brand new, some of the terms we've just dropped now may not trigger right away, like volatility and Vega and earnings, but that's just part of being new to something. And at some point, you're going to design and develop a system. And this is the great thing about that, is that it will speed up your time to trade. It will bring up your confidence because you've tested the numbers and you understand them. And then it will allow you to just kind of execute your business while you're still living your life. The thing about trading, and I know this to be just true, and I see it all the time, it's obviously hardest when you're new because you're learning every little thing, right? I tell people, Brad, quite often in the very first class they ever take, I say, this is the hardest class you'll ever take, because not only are you trying to learn all these new terms and all these new definitions, you're trying to understand the business to begin with. As a trader 4.5 years in, you know the power of trading and what it can do for you. What are your goals, from an ROI perspective, Brad, on a yearly basis? What do you try to make, from your trading?
Yeah, it depends on the strategy, but I mean, overall, I feel like I'm just trying to beat the crap out of the indexes.
Yeah.
10% that doesn't cut it for me. That might be good for a lot of people out there, but if you're just doing simple strategies like theta strategies, if you can't make 35, plus % per year, then, why spend so much time doing all this if you can't, beat the market?
So you're trying to beat the heck out of the index. The index might make 8% a year. You're going for 35, 40% is what it sounds like.
Right, that would be, conservative. If I'm trying to do some more delta strategies or something, then it might be more than that, which is actually something I've been working on a little bit, was a delta strategy, because I was noticing in my stock reports that I did last year, I did 8 or 9 of them, and I had about 73% winners and got about 35% ROI on my account within those 8 reports. So that's what, 2 months? And it was about over 4 months of time, because I didn't do the report every week. I just did it every couple weeks or whatever. So that was just some back testing that I went back and did, because I wanted to see how my reports were actually doing for people. Yeah.
I love it. Guys, and if you're out there and you don't know what the stock report is, that's a weekend report and the scoreboard that we have, coaches and experienced traders and mentors put together for you guys to learn directly from them. The value of getting, information on a weekly basis, Brad, from somebody who's been trading maybe 5 years or 15 years. Like we just talked to Tyler. He's 10 years your senior in terms of experience as well. It's incredible, right? Because those reports you put together are fantastic, and I'm very happy that you're a member of our team and given back to our communities. I think it's pretty awesome. One last fun thing here, and it's all fun, but you had an interesting question in the clubhouse, and you're pretty active in the clubhouse. You asked for inspirational quotes. How much do you focus on self-development, fulfillment, reading, challenging yourself, all that kind of stuff? Is that a big part of your life on a regular basis?
Oh, yeah. Every day. Actually, one of my newest goals for this year was to read a certain amount of books. Mm-hmm. And I also posted on the Clubhouse how you can convert PDF files to Kindle files really easily, because that was my biggest problem. Was like, I wanted to read, but all I had was these PDF files, and I would never read them because it was such a pain to actually try to read it on my phone or on my Kindle. So now I can just be like, okay, I'm going to read 5% of one book per day, and that translates over time to about 18 books per year, which is way more than I was already reading. So, it's a starter goal. It's not 200 books a year like Warren Buffett or whatever that was, but yeah, it's a start. And then that other question that you were talking about with the inspirational quotes, I think it came from Noah on there from a different post saying, if these actually do help psychologically, mm-hmm. if you have these things. So I was like, okay, well, I'm going to actually do this. Get some posters that I really like of inspirational quotes and put them up around my office so that when I look around, I'm inspired all the time when I'm in here. So
there's no
it was just an idea that I had.
There's no question about that. Entrepreneurs know this. People in business know this. People in life just know this. you surround yourself with positivity and drive. And when I love the clubhouse we have there, because it allows us to kind of engage each other and talk and give each other tips and direction and all that kind of stuff. But even just fun stuff like this, because I think I answered with one of my favorite from Zig Ziglar, where Zig said, people often say that motivation doesn't last long. Well, neither does bathing. That's why we recommend it daily, right?
Yeah, I love that one.
Yeah, that's a great one. So I love that you're doing that, and I love your activity in the clubhouse. Trading Justice episode number 200 here, guys. Brad, what's one last thing you want to just say to our team out there? We get a lot of people listening to these that probably have seen your name or heard one of your reports. One bit of advice from you to new traders.
I don't know. I probably say the same thing every time I'm on here. This is my third time on the podcast, but keep it simple. Just keep trying and make goals and do everything you can, to meet those goals. I have a day job, unfortunately, at this point, but I still have time, for my family, for trading, for creating businesses. It's all about what you're motivated to do, and if it's something that you really want and your why is strong enough, then go out there and get it.
Absolutely. Very well said. And another one of our team members here, Coach Brad May, and you can get his weekend reports over there at Tackle Trading. Friend him on the clubhouse, communicate there. I'm sure that Brad would enjoy that. Say something to him about his interview here on the podcast. Brad, thanks for being here. Appreciate it. Guys, we're going to take a short break and come back with more of this podcast. All right, we'll see you guys in a minute. This is Trading Justice. Check out our sponsors, TackleTrading.com, where you'll find comprehensive trade information, including the current state of stocks, commodities, forex, and economic reports, and much, much more. While you're there, you can download the 7 Steps to Trading Guide, Tackle Trading's proprietary and exclusive PDF guide on trading the markets, and start maximizing your trades.
Welcome back to episode number 200 of the Trading Justice podcast. My next guest is one of my amazing counterparts and mentor, good friend, Keith King. Many of you guys you're familiar with Keith from Legacy Education, also been a part of Tackle Trading on the podcast multiple different times. Author of the Forex Report on a weekly basis over at TackleTrading.com as well. Keith, how are you doing today?
I'm doing great today, Matt. It's a pleasure to be here. Looking forward to an enjoyable podcast.
Yeah, me too. We felt for episode 200 to just bring on, everybody that's kind of helped us get to this point with Tackle Trading, with the Trading Justice podcast. And, I couldn't think of anybody better than yourself. I've said this many times, Keith, that just listening to you and your stories, I have learned more in that capacity than anything I've ever researched or anything like that. And it's a pleasure to have you on the podcast once again. But before we get into trading and investing and, stories from the floor and all of that, you're a big Patriots fan there, Keith. You excited about this past weekend?
Oh, I just had a great weekend enjoying NFL football. I was at New England's Gillette Stadium watching the game Saturday night. We couldn't get out of the parking lot because of the traffic till about 2 a.m, and I couldn't wait to get back there for next week's game. And for all those that hate the Patriots out there, sorry, but don't hate us. Just enjoy the excellence that is the New England Patriots.
Don't. What's the saying, Cam? Don't hate the player, hate the game. Something along those lines. The Patriots.
You can hate the coach.
Oh, you can definitely hate Bill Belichick. There's no doubt about that. As a lifelong Miami Dolphin fan, you and I have had some fun in the years. But I will tell you right now, I have grown to respect Tom Brady, respect Bill Belichick, and I will be very excited when Tom Brady hangs up his cleats at the age of 48 or 49 years old. Man, how in the world does he miss the first 4 games of this year, Keith, and come back and still be in the MVP conversation at the age of 38 years old?
Well, one thing helping him there is the system. He's really been involved in the system for some time. He's helped in the development of it. He's got some better receivers to throw to overall than he's had. Many of the years, Tom actually pulled a rabbit out of a hat. Sometimes they're not very good receivers, but this year he's got some quality receivers. It's the same system that he's been with, many of the same receivers now for 3 and 4 years. Even with Gronkowski out, there's other players to step up.
Gronk's just sick. There's no doubt about that. But Edelman Edelman's over the last 3-4 years, Edelman has stepped up. Then they got the new receiver from Arizona, just came over, picked him up after week 15. Deion Lewis came back. Yeah, I mean, they're good. But you know what? The one thing about New England that has surprised me a little bit this year is their defense reminds me a little bit of those Teddy Bruschi days. What have you seen with their defense?
Well, it's funny you bring that up because everybody talks about what a defensive genius Bill Belichick is, but after the first 4 years there when he came in and we won 3 Super Bowls in 4 years, that was really within a defense he inherited from Pete Carroll, the mastermind of Seattle's great defense. Our defenses were really bad for a number of years. It was strictly always just the offense trying to keep the team in the games.
Outscore.
But
yeah, exactly.
They've kind of gelled this year. Yeah, he got rid of some of our better, more high-profile players, Chandler Jones, and he's kind of found these younger guys that just seem to buy into his system that will stay with the techniques that he wants them to stay with, be where they're supposed to be. So anyway, it's kind of gelling. And we're a little bit suspect on deep passes. Our safeties aren't great, but we've got some good young cornerbacks, so they're kind of holding us together there.
Well, I'll tell you right now, I think you're going to be big faves next week, and Pittsburgh is not an easy out. They're going to bring Le'Veon Bell, the Bees, Brown, Big Ben.
3 Bs.
Yeah, they know how to bring us. So it's definitely going to be a great game. I'm sure you are going to be in tailgating mood all Sunday morning, preparing for a nice little Sunday evening game watching the Pats and Pittsburgh, no doubt about that. I think I'm gonna go out there on a limb. I'm gonna say 31-27 Pats. That's what I'm saying. 31-27.
Interesting. Let me just tell you something, Matt. I really do appreciate the fact that the NFL can put on the kind of games that it puts on. If there's anybody listening out there in Green Bay land, in Pittsburgh land, Atlanta land, aren't we going to have some great playoff games? 4 great quarterbacks, all in the playoffs, all quality quarterbacks.
I was reading a stat just barely earlier today that those 4 teams are like 30-2 in the last 32 ball games. And
crazy.
Just, peaking at the right time. That Green Bay Dallas game from yesterday was just off the chain good.
Amazing.
What can you say about Aaron Rodgers? I mean, wow. And then you got the Pats. You got Big Ben. You got Tom Brady. You got Aaron Rodgers. And you got who probably will be the MVP of the league, Matt Ryan. And
great.
If that doesn't tell you this is a quarterback-driven league, I don't know what will. But that's not why I brought you on the podcast here to talk about NFL, although I do really enjoy that. Keith, you've been around trading in the market for pretty much the majority of your life. You got into trading with your brothers there back in the 1980s in Boston when you became a floor trader and whatnot. And I've met a lot of floor traders in my day, whether it was in, with you in Boston or the New York exchanges, or, I've known quite a bit on the Chicago board or the Chicago Merc. And, they all say the same thing. They all say, well, you should have been here back in the day when this was happening or this was happening. And it's amazing to sit down with those individuals, have a beer, and just have them talk about what it was like on the floor. Keith, when we're traders now, we click buttons over the internet, and there is no floor traders that goes and takes opposite end of transactions. It's all high frequency driven. It's speed. It's efficiency models. It really does allow the individual investor access to the markets otherwise they didn't really have back in the 70s, 80s, and 90s. But Keith, kind of just explain to the listeners how it was being on the floor in some of those crazy environments in the 80s and 90s.
Sure, Matt. It was some of the very best working experiences of my life and some of the very worst working experiences of my life. In fact, I'll just start off with one tiny little anecdote that is true and that I'm always happy to tell people this. I say, the 2 happiest days of my life on the trading floor were, 1, the day that I reached the level of being promoted to be a floor official. Floor officials are the ones that get to make rulings. You act as a floor governor when there's a dispute on the floor, when there's a question, whatever. You get to make the rulings. How exciting, I thought. After doing that for a while and realizing that every time you get between 2 people that are screaming and yelling, you have at least one, if not both of them, mad at yourself. Well, my really best ever day in the trading floor is when I resigned from being a floor official. So it had its good points, it's bad points. I guess that's true of all jobs, but there was never a dull day. I mean, could have been a day when the market was a little bit sluggish, things weren't moving too much, but there was always something going on, whether it was the mutual funds really heavily working into one sector, one industry group, whether it was the hedge funds trying to kind of take control of the markets from the mutual funds. That's kind of how it evolved, Matt. In the 1980s into the 1990s, the markets were really controlled by mutual funds. As we progressed and the derivative instruments really kicked in, options began to really come into incredible popularity in the 90s into the 2000s. The derivative instruments like futures, the intermarket relationships with Forex, and of course, the technological developments. We really started to see a swing away from the mutual funds being in control of the industry to the hedge funds. But what I did really realize early on, I started off trading regionally. I was on the Boston Stock Exchange initially before I went down to New York. And after I left the New York floor, came back to Boston, I had an opportunity briefly in the 1990s to supervise trading operations for Payne Webber out on the Pacific Coast Stock Exchange. So I had some familiarity out there, how things work between the LA and San Francisco floors. But in a nutshell, the primary market, the New York Stock Exchange, that was far less dependent on technology throughout the 90s than was a regional exchange, because the New York Stock Exchange, when you're a floor trader, what you did is you worked the crowd. There was always a group of people milling about in front of every trading post. If you see the old TV reels, these are like in the 1990s, not really, really old. There'd be, people up against these banks of computers. They were the floor traders, and they'd be looking out at this very large group of people. They weren't necessarily there to just trade one stock with you. They might have been representing a group of stocks in that post or a nearby post. But I found out when I left the regional exchange in Boston, go to New York in the early 90s, I felt like I did more actual trading in the Boston floor because we didn't have that group of traders or this group of brokers in the crowd. So as buyers and sellers came in, mostly electronic through the system or being called out by a small number of floor brokers, we always took the other side of trades. I always felt I had exposure that way. It could have been a Goldman Sachs broker, even on a regional exchange, Boston, the Pacific Coast, whatever, that would want to buy or sell a large block of stock. But there was nobody to lean on, no crowd. So as a floor trader, I was basically positioning every single trade. When Payne Webber, the firm's now UBS Financial, but back when they were Payne Webber before they got bought out by the Swiss bank, when they asked me to go to the New York Exchange in the early 90s, I thought that would be amazing, and it was an amazing experience. But after spending just a short period of time down there, I realized my primary job wasn't necessarily to watch the charts, even though the charting wasn't quite as easy to follow back then as it is today. But my primary job was to kind of look away from the computers that I was steering into for years on the Boston floor and turn towards that crowd, because you could really tell how days were going to play out and what the market was going to do when you just listened to what the bigger institutions, and back in those days, well, it still is Goldman Sachs, but there was Salomon Brothers, Lehman Brothers, Merrill Pro, and a host of others. So I sometimes liken my job as a floor trader to being a traffic cop, to knowing there's buyers in this area, maybe there's some sellers mingled around here, and if a big buyer or if a big seller starts to try to overwhelm a stock, your job is to really kind of keep it under control. You don't want the markets whipping around. They really defined a floor trader, Matt, and to our tackle trading guests, they defined a floor trader as having the responsibility of keeping a fair and orderly market. Now, that's one thing the computers cannot do. The computers can only pair off what they have in their system. So the movements can get the market can be rather thin at times, and things can whip around quickly. But I would know in the crowd, for example, on a given day, that maybe the broker from Goldman and the broker from Salomon both said to me, we'll be working buyers all day long. Well, in that case, no matter what came up for sale, I'd fill everybody right in line with the bid price and with the ask or offering price, because I knew I had, dependent on the crowd, I had a lot of liquidity there. And when I left the New York Stock Exchange, I felt like I was trading again. For those years down in the New York Stock Exchange, even though we processed, oh my goodness, amazing numbers of trades, a lot of it was just being paired off crowd to crowd. So I felt like I came back to being a trader again in the mid to late 90s when I went back regionally, and even ended my floor trading career with a few years trading upstairs in an off-floor office, but printing as a market maker. So I can just say that basically, as everybody knows, technology has made an incredible difference to the world of trading. And those former crowds that at one time were all over the trading floors of the New York Stock Exchange, they've long since disappeared. It's all trading now electronically, and there is that electronic ARCA exchange, ARCA, which the New York Stock Exchange made news in 2003. When they bought out that electronic exchange, they paid a fortune for it. But that electronic exchange, which took over the former Pacifico Stock Exchange, that managed to pull 80% of the New York Stock Exchange of business away from the New York Stock Exchange from 2001 to 2003. That's when the New York Stock Exchange really started to change from a floor-based trading exchange to more electronic. So if you have any questions, I don't want to keep rambling on. We can certainly talk about some of the fun times on the trading floor and what it was like when a day like the crash of '87 came and all that stuff. But basically in the New York floor,
I do want to pick
there's a crowd.
Yeah, I do want to pick your mind on that, but I've said many times, Keith, when you talk, I shut up, and that's kind of how it is. So, but one thing does kind of just spark a thought in my mind, because when it comes to trading, and when you were in Boston, when you're in the regional exchanges over here on the Pacific West Coast, it was more you would look at charts, even though charts was a lot harder. And we're constantly ingrained in trading to trade with the trend. The trend is your friend. But when you went to New York, it sounds like the trend wasn't about the technicals, but about the people. It was more about, okay, what institutions were doing what, and it was following those people. And that's a staunch difference between how we trade today and how you were trading on the Boston Exchange versus, say, the New York Stock Exchange. Keith, in terms of let's talk systems of trading, because you were talking about how in the 1980s and early 1990s, how the mutual fund industry was really the predominant leader of market movement, and how in the 1990s you started seeing hedge funds and institutions start getting into it more than just the mutual fund industry. And then in the early 2000s, we really in the late 1990s and into 2000s, we really started seeing derivatives. And I want to talk about how derivatives have changed, traditional investing, systems, portfolio design. In your estimation, coming from the 1980s to 1990s, we still had derivatives then, but they weren't necessarily as liquid or as popular as they are in today's environment. How has derivatives changed your approach to how you go about your personal investing?
Oh, that's a fabulous question, and you're really spot on. In the very early days of program trading, that being using derivatives to take advantage of, or I should say, to take advantage of the differences between a derivative such as a stock index future and the underlying stocks, I noticed the regional exchanges by watching the charts. And this is kind of a revelation because this was not written anywhere. But I noticed back in those days, whenever I would see a buy program kick in S&P index futures or NASDAQ index futures, over the next 10 or 15 minutes, the S&P 500 stocks would rally, the NASDAQ stocks would rally. Then I'm down on the New York floor, and I find out that the traders down there really were not in tune that much to futures. There's a gentleman from CNBC. He's always on in the mornings. I don't know if you know him, I won't use the name, but he was kind of walking me around. Payne Webber's head of floor operations. He's still on CNBC. I don't know if I should mention his name, but he was kind of helping me realize that the derivatives were starting to take control. But the funny part was, if you watch the futures, you would have a 5 or 10 minute head start before the stocks would react, because in those days, the institutions, mutual funds especially, would be calling down orders to floor brokers. Well, they were all located out in the sides of the room. They had the broker booths all around the sides, the inner areas of the trading floors. There were 4 separate rooms in New York at the time, but that's where the floor traders were. And then maybe 5 or 10 minutes after the futures rallied or sold off, you'd start to hear this din building, and this din building is this little army of floor traders came running out onto the floor screaming, buy this, buy that, sell this, sell that. Well, nowadays, that's being done electronically.
Yeah.
All that changed, when they had like that ARCA exchange and the electronic access that institutions have to computers. So what it's done for me is I still watch S&P futures and NASDAQ futures pre-opening and around the opening to see the direction of the institutional involvement. But as far as my own trading, now I depend much more on the charts. I keep a group of, focus stocks, a watch list. And I probably shouldn't say this publicly, but it's the truth. I don't really love doing a lot of fundamental research. So I keep a group of stocks that I have researched. I know the fundamentals. I know the product line. I've gotten into the details of how they react to earnings, etc. So I use those for my longer term strategies, for the option strategies. If it warrants it at the first couple of months of a year, can do calendar spreads if things aren't quite that dependable on the weekly to the monthly charts. Do the regular trades that we espouse to all of our clients, the debit trades, the credit spreads. But I still realize that link between the institutions and the retail trading community exists electronically. So I just want everybody to realize the charts really will give you up to the minute, up to the second of what the institutions are doing. So when it comes to investing, I think everybody realizes this. If you like a chart of a stock, just say you're perusing daily candles of a stock or a sector, an ETF, etc., do yourself a favor and look at the longer term weekly candles. Always lean on the direction of a longer term chart to do what you're going to do on a shorter term chart. But as far as the derivative instruments go, again, I just know on a daily basis if the futures are rallying, stocks are opening higher. If futures are selling off, stocks open lower. And some things haven't changed. When the market's gapping up big, maybe a day the futures are up overnight in the pre-opening trading, the overseas trading, and you can see ahead of time. Look at your brokers, look at the media, if you want to look at Bloomberg, CNBC. When I see the markets opening higher, if one of my stocks is gapping up for no reason other than the futures went higher overnight, that's a great time to take profits.
Yeah.
The majority of the time, there is some kind of retracement. Not if the stock has had news, however. If stock has had news, then it's more likely to do a gap and a go. But anyway, it still comes back to us being able to read charts. Yes, Matt.
I want to ask you about that because over the last 20 years, we've seen globalization really impact the market more than we did in the 70s, 80s, and 90s. And
Yes.
which means we see a lot of overnight activity in the S&P 500, in the Dow, in those major market indexes. And I think that is a great pro tip in terms of saying, okay, if we're seeing the S&P 500 go up based on some type of thing that happened in Europe or China or Japan or Great Britain or wherever those overseas markets exist, and the S&P 500 is doing favorable action, but our stock has no news, but it's just getting a pull from the market itself. What a great tip to say, okay, if your stock's going up based on the S&P 500 futures, then it might be able to lock in some profit, because that's kind of what's going to cause that retracement is other traders coming out there and locking in profit as well. And another thing I want to kind of mention that you were talking about, you said, I don't know if I should say this publicly, but I don't like doing a lot of fundamental analysis. I see this, Keith, as high frequency systems that are largely technical based. As we've seen more technical charting become more important in trading, it really has led to a decline in the importance of fundamental analysis. Would you agree with that?
Yes, I certainly would. In the first place, not to drop a name, but there's an author, Peter Lynch, who used to be a fund manager for Fidelity Investments. He happens to be located in Boston. And after he retired, he would visit the Boston Stock Exchange trading floor. His next door neighbor was one of the floor traders who happened to be at a post nearby. So I had some conversations with him. And when he started telling me how he at Fidelity Investments, one mutual fund manager, they had many mutual fund managers, but he had access to a pool of a couple of hundred fundamental analysts. And right away I said to myself, well, I guess I can never do a better job at researching fundamentals on my own than a mutual fund can do. And yet, how are your returns in your mutual funds? I got out of my mutual funds years ago because I was never happy with the returns. So it really has become the issue that the technicals is what we have to follow. We all teach our clients, Matt, trade the way you are seeing the charts. Don't trade the way you think a stock should go. There can be, and there are daily cases where stocks don't have a particularly good outlook fundamentally, but they're in favor with the institutions, the high frequency traders. They're moving it higher. So another thing we got to say on the trading floor is just when things are doing that, when they're going up despite the fundamentals being weak or earnings being decreasing, whatever it might be, earnings forecasts being decreased, we'll just say hold your nose and buy them. You just have to follow the trend. So I truly do believe that we have to make a good part of our decision more on the technicals, because that's what the institutions are actually doing. The fundamentals is what they will probably be doing over time. And it goes the other way around. A company can have fabulous fundamentals, but we may not be able to do a bullish trade on that company. We used to say nothing's cheap when the institutions are selling. When they stop selling, then everything is cheap. So I just love the way we teach our clients, starting in Master Trader, the technicals, getting familiar with watching things, so the top-down approach, and depending on the technicals of the indexes, the sectors, if you want to get onto the industry groups. But all the traders that I know from the trading floors, that's where most of them came from, many from institutional trading desks. To this day, they make a living depending more on technicals. And I think our parents' generation probably did, at least should have been using the idea of buying the fundamentally strong companies and holding them. And even the great Warren Buffett says he hasn't been utilizing that strategy the way he used to be able to in the past. There were years like 2015 come along and the market did nothing. So yes, I do believe we do want to, in my case, I depend more on the charts, but it's a combination. I don't want to say that I'm just going to buy something and hold a longer-term position when I don't trust the company based on its fundamentals. We can use strategies there, of course, to mitigate risk. But the technicals, I think it's levelized the playing field. I really do. I saw things on the trading floors that individuals off the floors couldn't see at that time in the early mid-90s, late 90s. But nowadays, no, we do all get the same technicals. We don't necessarily know what those dark pools of capital are doing at any one point in time and just what the institutions might be doing behind the scenes. But depend on your charts, depend on the trend. Make sure you are trading stocks that you understand. And every now and then you'll hear this company. I'm like, well, what are they doing? I don't even understand what they do, so I don't invest in them. Whether that's a good thing or a bad thing. But you should know your companies. You should know that much about them, and definitely go with the charts, because I will say this, even towards my late days of floor trading, when I had left the New York floor and came back up, I'd still go back down there and visit it. And I would laugh because they had picked up into the world of technology into the 2000s. In the late 90s, Matt, the floor of the New York Stock Exchange was still completely littered at the end of the day with paper, with trading tickets, and just everywhere. By the time I went down to New York in the early 90s, the Boston floor was pristine at the end of the day, because everything by then had already been working through electronic systems. So anyway, that's one thing. We saved a lot of trees.
Yeah, that does lead me to a question. Why do you think the regional exchanges like Boston embrace technology faster than the national exchanges like New York?
Well, we really had to, because there was no way that the regional exchanges could compete with New York on those very large institutional orders. So we were approaching the discount brokers like the Charles Schwabs, the Fidelities, when all of the big brokerage firms in New York started rolling out their streamlined trading systems. We had approached them to be able to track their business. So what we were doing is we were getting it from a technological perspective, saying, look, we can guarantee faster executions, price improvement. Back in the days, Matt, when stocks traded in fractions, there was markets that might have been a quarter to a half. That nowadays, that's a 25-cent spread. I sometimes saw markets back then a quarter, 3/4. So what we did is we used the technology where we had a system built in that when there was a spread beyond a certain size, we would guarantee price improvement.
Keith, we've been talking about how fundamental analysis has kind of shifted its priority to more technical analysis over the course of the last 30 years. I also want to ask you another question, and this goes to the heart of those moments in time in the market where we get something happen that just freaks the entire market. And these are commonly referred to as black swan events. In like the 87 crash, the 97, Asian currency crisis, 9/11, Lehman Brothers, China from last year, these types of things. How have you seen the market behave differently from your time on the floor during, say, the 87 crash and the 2001, 9/11 situation compared to more recently? Like, for example, in 87, when you were in the crash,
correct,
you were
yes.
still in Boston, correct? Okay. Explain to the listeners kind of how chaotic that got.
That became a completely chaotic entire day. The order feed lines were delayed. They couldn't keep up with the speed of the orders entering. And in fact, it happened in the New York Exchange, even though I was trading in the Boston Exchange. Same thing in Boston, the other regionals. We weren't prepared for a day when that many orders were going to come into the system. So obviously technology has changed so that far large, hundreds of folds, large number of orders can enter. But what's happening in the Boston floor is, as a regional floor, we have to honor New York markets, but New York markets are running late. So all day long, we had sellers coming at us. We're giving them quotes as best we can based on what the primary and regional markets together are showing, the national best bid and offer, the NBBO as they called it. And they were running very, very late. So it was kind of a chaotic event for us because we knew with every single order we executed, it was mostly sell orders, that would be losing money. But even in the crash of 87, there were brief periods of time where the buyers would kind of pick up. And there was some preliminary trading in futures at that point in time. And maybe they rallied a little bit. So all we could really do is make sure every time there was any kind of a rally, we would try to liquidate a little bit into that rally. We ended up carrying some heavy positions overnight into the next day, and the markets looked pretty unstable in the opening. But it was really the failure of technology. The links that we used back then to connect primary and regional exchanges were not functioning. The NASDAQ market was worse because they had no technology at that point. They were using phones. The NASDAQ dealers would be calling one dealer to another, trying to see if the market was good, and the NASDAQ dealers weren't picking up their phones. So there was really no national market system on that day. But the technology, of course, is so much better. And I said it earlier, Matt, I think it's leveled the playing field. I really do feel like our clients, we can all learn to trade the markets in a very safe manner. Obviously, our classes do that great job of using derivative instruments in a way that we are mitigating risk. But sure, back then, I felt completely exposed. I really didn't know what the true risks I was taking that day was because I really didn't know what the true markets were. But I had to honor customer sell orders. If we didn't honor them that day, we weren't going to get them back on subsequent days.
Yeah, no doubt, and I agree with that, Keith. I think, back in the 80s and 90s, the brokers, the market makers, the hedge funds, the institutions had so much more than the individual investor did, not only from an access to the markets, but a speed and a liquidity part of the market. It was so much more difficult for someone like myself, for example, to learn how to trade and be a trader and place trades. It was expensive. It was slow. You were getting information from a newspaper versus, the wire from the exchanges, and those things have changed so far. And it's something that every single one of us can take advantage of. One of the last questions I have for you is, on September 11th of 2001, it was a Tuesday. The markets weren't open yet, right? When the planes first hit, if I remember.
It was right before the 9:30 opening of stocks. That's correct. But Matt, actually the ETFs were trading.
Yeah.
I was able to sell some Qs and spiders after the first plane hit, but before the second one did. But yes, the equity markets had not yet opened. In fact, they evacuated the trading floor of the exchange before 9:30. Yes.
Didn't they shut it down immediately?
With the second bombing they did, they evacuated the whole trading floors in New York and regionally, and we didn't open again until the next Monday.
Yeah, it was like 4 days off the market the next Monday. What was the trading floor and the mentality like on the floor that first day the market
I'll tell you,
after 9/11?
it really was a patriotic event. We just inundated the trading floor with U.S. flags, and we had the attitude, the terrorists are not taking down our financial markets. Everybody made an agreement ahead of time. We'd stand up, and we would make sure the liquidity was there for any nervous sellers. Actually, I thought we did a really good job across the board of just saying we're not going to let that terrorist event affect U.S. financial markets. So I really liked that day. I thought that everybody pulled together. I was back regionally at that time, but the New York traders, they didn't have that normal animosity they have for the regional traders. I really thought we all did a good job, and I'd be sharing some of my limit book with them from the extent just saying, okay, I got this kind of an order. You got some liquidity. Let's pair it off. So it was a period of cooperation. Let's just say that.
I love hearing that all the floor traders came together on such a horrific moment when the market was coming back open. They said, you know what, guys, we're filling orders today. We're all are. We're any nervous
everything
sellers,
that comes.
We're taking the buy order.
Everything.
And the market and you know what? The market actually recovered fairly
quickly.
It did. After that.
It did. I mean, it was just even the brokers were saying, even the brokers who are usually very secretive of what they will tell a floor trader, they were saying, look, we're going to have some support for you here. We got to get some sellers up in this area. We worked together. It was a very actually smooth reopening of the markets. It was just too bad they were down for 4 days.
Yeah, no doubt. But looking back, it probably gave the entire nation a little chance to take scope of what was happening. It took the traders some scope of what the damage truly was, and that moment in time, seeing people come together in every different walk of life, and certainly on the floor and in trading as well. It gives me a little warmth in my heart there, Keith. Keith, it's been an absolute pleasure having you on the podcast today, and as we have in the past, and I look forward to many conversations in the future. And just thank you so much for providing so much detail to that Forex report at Tackle on a weekly basis. I know our listeners and our members over there at Tackle appreciate it. One last thing, Keith, if you would give a new trader a word of advice as they are just starting out their career, what would that
No
be?
doubt about it. The same thing that every mentor at Rich Dad and Tackle Trading always professes: concentrate on the risk side of the trade first. Everybody comes into it with the eyes wide open, thinking they're going to be overnight millionaires. Trading's a marathon, folks. Build your profits over time. Take the safe, secure trades at first. Always pay attention to the risk side of the trade. As your trading skill increases, your profitability will increase. But it's not something you really, unless you get lucky, you're not going to make $1 million overnight, or unless you're taking a position way bigger than you ever should. Learn to trade the safe strategies. Learn to control your risk. And over time, the profits come. They absolutely will come. So it's a marathon.
Wise words from the great Keith King. You've been listening to TJ episode number 200. Keith, we're on 200, and I can't wait for another 200 more. Thank you